Hello and welcome. This week we are going to talk about funding new ventures, different sources of capital and why you need capital, then what are the advantages, disadvantages of the capital and how to go about it. So, at the beginning these are the list of the sessions that we are going to have, 5 sessions. On first session is on introduction, general discussion, then bootstrapping, crowdsourcing, incubation, acceleration. Then we will talk about business angel, business venture capitalist, venture capital fund, then debt funding, government assistance. There are grants and other seed monies, etc. Today's session is introduction on general funding. Before we move on to the main topic, here is just a news item. I just wanted to emphasize on this part we discussed earlier. Just look at the tragedy of people who are being fired when companies cannot really sustain with the existing number of employees. I mentioned earlier that before recruiting, one should be absolutely sure that we really need these people for achieving growth, or we need to feel critical knowledge gap, only then we should recruit. Now, one day's news tells us about so many reduction of employees, and they are all big names like Ola, like Voyo, like Paytm, who not, Zomato, and they are firing people because these people are not necessary for their present operation. Now, look at the disruption that you cause to those people, look at the disruption that you go through, because firing people brings in a different kind of fear psychosis among your existing employees, and then chances are very high that some employees will think of even quitting with apprehension that any point of time even they may be fired. So, firing is a very dangerous decision and avoidable decision that we should think before even hiring. I just wanted to emphasize on that point. This is an example when I talked about being cautious before hiring. This is just to buttress that point. Now, we should understand that capital is the lifeblood of a new venture. We have already seen empirical evidence that about 60-70% of the companies die because of several reasons that lead to shortage of capital or run out of money. Even if the reason may be that customers are not buying their product, that is why they are shutting down, and many occasions it so happens that the growth is not happening, and then companies run out of money. So, running out of money is a very important issue in a startup success and a startup failures. So, we should be knowledgeable about where to get money, how to get money, when to raise money, etc. So, capital will ensure that we sustain for a longer time and success will come at some point of time. But if you fail to raise money at a certain point of time, even though business is going good, maybe you are burning cash, but we need cash to run the show. So, at any point of time we run out of money, and we have to call it quit, even though business has potential. And funding decisions are very tricky. Suppose you raise a lot of money at the early stage, then you give a different kind of a feelings to your employees, to your executives, that there are a lot of money, and they start spending money. You burn a lot of cash, which is unnecessary. Like many companies, they realized after they failed that they actually unnecessarily spent so much money that was avoidable, and they failed because they did not avoid those expenses, and then eventually they died. And this kind of habit of overspending comes when you get too much of money. So, too much of money is not at all good. Just like too little money will not let you move forward, too much of money is equally dangerous. It also leads to failures, more number of failures perhaps than running out of cash. So, decisions to raise capital and then how much to raise is very, very important. Particularly, suppose you are at the very early stage of a startup. Now, you just maybe registered a company and developing a product, you are tempted to ask for money, and if there is opportunity, you will be going on giving presentations after presentations. That perhaps should be avoided, and you should always try to move ahead with your development process as far as possible and as far as practicable, because raising money has many implications. The first implication that is that you are going to dilute your equity. Dilution of equity is not so much of a curse, but then you have to save equity for raising more money moving forward. If you dilute it significantly at the early stage, then there will be very little equity to offer to your future investors, to your employees, and then eventually you will find that whatever equity is left with you, it does not make you motivated to run the show. You also need to have adequate percentage of equity holding, so that your value goes up, otherwise why you will do business. So, you should always try to move ahead without raising money and then try to run the show without really external assistance. We hear a lot of stories about venture capitalists making something like 100 times their investment and what not. So, we should be like very careful about all those metrics. Say for example, some company like say Peter Thiel invested $5 lakh, just $5 lakh in Facebook at the early stage, and eventually after 8 years he sold this stock for $1 billion. So, he converted $5 million into $1 billion. So, perhaps many people had this opportunity to invest $5 lakh in Facebook, but they could not make a decision to whether to invest or not to invest. Now, somebody invested, he reaped the benefit. Now, there are many occasions when Peter Thiel invested maybe another 5 lakh in number of companies, and then it actually did not return anything. So, investment from that point of view, from investors point of view and from a startup point of view, these decisions are very tricky. And then success depends on many factors, not just the business model, it is the attractiveness of the business, then the team, the traction that you have achieved. So, depending on that, you will be helping your investors to make a decision. If you are too much at an early stage, even they will feel this is too risky a business. Let us look at more tricky issues and with examples. Like Airbnb approached to many investors with their business plan for only $1,50,000 in exchange for 10% of the equity. Many investors sent a regret letter that sorry, we won't be able to fund, and rest of the investors did not even bother to send a reply, not even a regret letter. And then if someone would have invested say $1,50,000 at the time, I said in 2008, when the company was just in the formatting stage, 9 years down the line, that person would have made $3.1 billion for the 10% equity. In fact, at today's valuation, 10% of Airbnb is about $40 billion. Airbnb is a wonderful success story, but then when they approach to so many people, if they approach to any of us, perhaps we would have thought the same way, that this is not a business that can be funded, because they expected people to visit inside the house, visit and stay with a stranger that has no kind of acquaintance with them. They do not know anything about that culture, the kind of people that they are. Even today, without suppose Airbnb does not exist, you ask anybody offering this business that offering this opportunity that somebody can go to some country, say in Iraq, Iran, or say Turkey or some other country, and then stay with a homeowner. Perhaps most of the people will say no way, but then Airbnb had this leap of faith. They had some hypothesis, and eventually they enacted a success story. Company is valued now $40 billion. Many venture capitalists miss this kind of opportunity. Many venture capitalists fund this kind of businesses and then they burn their finger. So, this is just a tricky thing. That is why we should always put ourselves in the shoes of investors and then think what kind of comfort, what kind of confidence that we are giving to the investor. Only then we can actually think of expecting a positive response from investor. There are different kinds of, means money comes in different forms, meaning that they invest in both equity, in preference shares, they also give debt, some of them give grant as well. Now, if you get equity from founder's point of view, this may be good, this may not be good, depending on whether you are interested in diluting your equity, whether the cash flow is good enough to raise money in the form of debt and then repay and then save the equity. So, there are a lot of trade off between dilution and cash flow and then repayment, etc., for making a decision as to in which format you want the money. At the same time, investors may not be interested to give you the money in that format. Most investors prefer to give money in the form of convertible preference shares, not even debt. So, there is always a trade off here again. Equity investment gives ownership to investor. If somebody invests in equity, he or she becomes part owner. Preference equity share is kind of a mezzanine capital, meaning that it has both features of equity and features of debt. Debt is nothing but loan that you take and pay interest, and after some period of time you repay the loan. So, you have to repay. If you do not repay, the lender will take you to court and then there will be bankruptcy decree against you. Then grant is the most attractive part of the capital. You get it free. Grant is normally given by government, because government has the prerogative and the responsibility to promote industry. So, they always try to entice entrepreneurs with subsidy, with margin money, with seed capital, etc., etc. Just imagine that we have two Tata group of companies in India or two Reliance Industries groups in India. The economy will be at least say 10% larger compared to what we have today. But how this happened? Some entrepreneurs took the plunge, they invested their risk money, and then gradually they have grown. They have now Reliance gives employment, direct and indirect employment to maybe 10 lakh people or even more. Tata, same story, and then their contribution to our GDP, our government income is colossal. If we have 10 such groups of companies, our GDP will almost double. So, government has a responsibility to nurture early stage companies, so that someday some of them become Reliance, some of them become Tata group of companies. That is why all those supports are there. Now, suppose you think of approaching to an investor, now that you have just registered your company and then you need some money, then you need to know the purpose of this money, why you need the money, what are the kind of expenses that you need to incur moving forward for which you need money. Unless you have a clear idea, you will not know how much money you need, or if the question is thrown back to you, why do you need this money, then you will be blubbering, I need money for prototyping, and then perhaps you will not find many items ready in your mind. you need money for many purposes, like startup expenses, like say registering a company, early salary, like you need some people when you are building a prototype, market research, then you need design a logo, travel, legal expenses, trial expenses, advertisement and promotion, little bit of that, rent, utilities, etc., etc. So, these are the expenses that is normally incurred even before perhaps registering a company or before you go to market, at least before your product is ready and you are ready to go to market, you incur all those expenses, and the sum total of them is referred to as preliminary and pre-operative expenses. Preliminary and pre-operative expenses. These expenses remain in your balance sheet as an asset, as long as you do not write it off. If you remember financial statement lectures, we treated this preliminary pre-operative expenses as an asset and we amortize them, meaning that we use them up every year a small portion, that is how we amortize them, and then eventually it is supposed to become 0. Some means moving forward we want to write it off. So, that becomes part of our balance sheet. If you remember the balance sheet, on your right normally we have either a T shaped balance sheet or a column, single column balance sheet. If it is T shaped, then left side will be asset, like current asset includes cash, inventory, other current assets. Long term asset or non current asset will be machinery, computer, software, interior, furniture, preliminary, pre-operative, then the total asset. These assets have been funded by equity and liability. So, equity and liability comes on the liability side, and these are the sources of money that funds all of this. So, you prepare this kind of a balance sheet to understand where do you stand. Let us move forward. Once you are ready with a prototype, now you want to go to market, then you need a different kind of expenses to be incurred, like say you create infrastructure, like maybe by buying machinery, building factory shed or something, you need working capital. You need working capital to buy raw material, prepare goods in process and then prepare finished goods, receivables, etc. You make sales promotion because now you are ready with a product. So, you have to promote your product, build brand, requires a lot of money, set up logistic, and then for maintenance or post sales service you have to have a separate division, employee benefit and many more things. So, you need money for that. So, depending on at what stage you are going to prepare a requirement of money based on all these items which you think that you need. Among sources of money, the one very significant item is equity capital. Equity capital is the money that founders bring in and investors also invest in equity capital. Reserves and surplus is the accumulated profit. So, let us focus on equity capital and how it changes owner's structure or percentage holding. Now, look at this, left side is asset, right side is say liabilities, equity and liabilities. Now, this means these are the source of funding. So, you look at equity. Suppose we have just populated with some data. So, owners have invested 20 lakh rupees, suppose this is in 1000, at the top you fund, you see 000 omitted means this is expressed in terms of 1000, 2000, that means 20 lakh rupees. So, owners invested 20 lakh rupees in this business. Now, normally owners investment are in terms of some securities called equity share. That means, every money that you invest or the total money that you invest represent some number of shares. Usually shares are of rupees 10 each, that is called face value or par value. It can be 1 rupee, it can be 10 rupee, it can be 100, 1000, 1 lakh. There is no fixed rule, it is not a fixed amount. So, you can have anything as face value. Suppose you have 10 rupees as face value, and if you have invested 20 lakh rupees, that means you have invested in 2 lakh shares of rupees 10 each. That makes 2 lakh into 10 is equal to 20 lakh rupees. Now, total founders, say there are 3 founders, they have invested 20 lakh rupees. So, they have invested in 2 lakh shares precisely. So, let us move forward. Now, suppose co-founders are A, B, C. A invested in 50,000 shares, that means 50,000 multiplied by 10, that means 50 lakh rupees. So, 50 lakh rupees or say 50,000 shares, either you divide 50 lakh rupees by 20 lakh or you divide 50,000 shares by 2 lakh shares is the total number of shares. So, your holding becomes 25%. C invested 80,000 in 80,000 shares, that means invested 8 lakh rupees, 80,000 into 10, and the total equity capital is 20 lakh. So, either divide 8 lakh by 20 lakh or divide 80,000 by 2 lakh number of shares, his share holding is 40%. Similarly, co-founder C holds 35% of the equity. Now, suppose you invite someone, some investor, you need some 5 lakh rupees of investment from somebody. So, that somebody came in, and then it may or may not be 5 lakh rupees, but you are giving that somebody 20% share. Suppose that somebody is bringing 1 crore rupees at some point of time. You may need investment and somebody is investing 1 crore rupees. Now, that somebody demanded that you must give me 20% of the equity. So, how many shares make 20%? The 1 crore rupees that he or she brings has no relation with number of equities that he or she gets. It is the percentage holding that determines. Now, if that investor tells us that they want 20% equity, that means post money, meaning after investment, their shareholding will be 20%. Your shareholding means combined holding of 3 co-founders will be 80%. So, 50,000 plus 80,000 plus 70,000 means 2 lakh share will now represent 80% of equity. So, the total number of shares is now going to be 2 lakh divided by 80%, because you have 2 lakh shares and that is going to represent 80%. So, total equity becomes 2,50,000 shares. Deduct 2 lakh from there that you are holding, you get 50,000 shares. So, investors have to be given 50,000 shares, they will hold 50,000 shares out of 2,50,000 shares. So, they hold 20%, but they brought in 1 crore rupees. So, that has no relation how much holding they get. So, understand this very clearly. Now, this is just presented in different format. So, A hold 20, B hold 32, C hold 28, investor get 20%. How is it so? Because now the total number of equity shares are 2,50,000. You 3 continue to hold 50,000, 80,000 and 70,000 divided by 2,50,000. So, your shareholding has gone down from the previous structure. Now, an investor can, as I said, bring equity in preference share, debt share, and what are the consideration for this? We will be talking about that moving forward. I am just introducing that there is something called seniority of creditors. Suppose investors bring in money in terms of equity or preference share or debt, then suppose there is a liquidation event, whatever that is, maybe a bankruptcy or maybe you are selling your company. The debt holders get their money first. If anything is left, then it goes to preference shareholder. After paying off all the money to preference shareholders claim, if anything is left, then only equity shareholders get money. So, now you understand that any investor ordinarily would prefer to invest in debt rather than shares, either equity or preference. But then if they bring in debt, their top line also is limited, like if the company valuation goes up, their value does not go up. So, we are going to discuss that moving forward. So, suppose most of the new entrepreneurs, they think that we need money immediately, but then the risk, they should understand that at the, if you are at a very early stage, investors will think that this is unlimited risk. So, they will try to dilute your equity more. In the previous example, if you are very much at an early stage, if they bring in 1 crore rupees, they will ask for 90% of equity, something like that, because they will think that my money is going down the drain, but if I get majority holding, maybe I can take care of the management, etc., etc. More importantly, if there are 1 million ideas at the beginning, then as they move forward, by building new developing the idea into say some kind of prototype or something, ideas fall on the wayside, meaning that they become untenable, they do not become successful. So, gradually very few number of ideas actually sustain at the end. So, risk perception at the beginning is very high, because failure rate is very high, whereas when at the later stage you have a prototype, is customer validated, chances of failure is less and you get more money. This slide shows how much money you need. Sometimes you think that you tell somebody, why do not you start a business? You will say, I do not have a crore of rupees, so how can I start a business? Look at this example. Hewlett Packard started their business at $538 and their valuation is $33 billion. Threadless started business with $1,000, valuation is $1 million. Dell started at $1,000, valuation is $36 billion. Valuation are all billion dollar. So, look at this graph and this amount of money that they started with, you find no correlation at all. You do not need billions of rupees or crore of rupees to finally make a $1 billion company. And to drive home the point about risk perception, about the kind of investment that you should look for at different stages, I have this slide. So, you start with say at idea stage, you have your own money. So, this is all bootstrapping, your own source. Then as you move forward, you bring a co-founder, he or she brings in some money. So, you are still on your own. Then you think of inviting maybe your uncle or somebody, friends, relatives. Let us consider that you invited your uncle and he chipped in some money. At the idea stage, you had 100% holding. At 2 co-founder stage, you have 50-50 holding. Now, your uncle has chipped in, so he is going to demand some holding. So, 2 co-founders hold 40% each, uncle hold 20% hypothetically. Now, as you move forward, now you approach to angel, because you need more money, you have already built a prototype, now you want to go to market. So, you need lot of money. Now, angel said we can bring in 1 crore rupees, 2 crore, whatever, 1 million, we need 15% holding, 15% of the equity. Now, all your holding goes down. Founders who had 40% each now become 25-25, uncle have 12.5, and you prepare an option pool for employees like ESOP, like employees stock option. You prepare a separate pool, you keep that reserved for employees, maybe 22.5%, that is a condition that angel may stipulate. Then you move forward, you need more money, lot of money. So, you approach to venture capitalists, they say we need 20%, your holding goes down and your valuation goes up. As the valuation is the orange color line, dotted line that you just follow, it is going down. Finally, you need lot of money and you want to reward all your investment by making your share liquid. So, you want to go for a public issue. So, now public will be holding 10%, all others holding will go down significantly, and then there are a lot of shareholders with IPO. It is a success, complete success story. Your valuation is going through the roof and everybody reaps the benefit. So, as I said, your holding goes down. Some private organizations also provide grant, like I was talking about grant. Some private organizations like Willgrow, they give grant as money. We will talk about that in the next session. Thank you. Thank you for